So what is the number one tax write-off for real estate investors? No, it's not repairs or maintenance or real estate taxes, and it's definitely not insurance or management fees. So what is it? I'll tell you. The number one tax write-off for real estate investors is depreciation. And today I'm gonna break down depreciation and how real estate investors can use it to save thousands of dollars in taxes. If you wanna understand how depreciation works, what it is, and how it can greatly benefit you in real estate investing, then please go ahead and give this video a like and we'll jump right into it. Welcome back to the channel. I'm Crystal, a CPA here at Life Accounting, where we help you boost your profits and reduce your taxes. Today's video is all about the number one tax write-off for real estate investors, and that is depreciation. Let's first start with why this write-off even exists in the first place. Real estate is one of the most tax-advantaged investment vehicles. The federal and state governments structured tax laws to incentivize specific behaviors, and real estate ownership is one of the most important behaviors they want to incentivize taxpayers to do. Which makes sense. The more homes bought in a certain area means more people are living in that area, which then also means the economy in that area is being stimulated and more tax dollars are being collected. The government wants you to invest in real estate because it means more tax revenue for them in the long run. And the depreciation write-off is an incentive that allows real estate investors to take advantage of some huge tax benefits. Well, what exactly is depreciation? According to the IRS, depreciation is an annual income tax deduction that allows you to recover the costs or other basis of certain property over the time you use the property. Pretty much meaning that the IRS understands that yes, over time an asset or piece of property experiences some type of wear and tear, and the asset loses value because of it. And after so many years, the asset effectively becomes worthless. This cost is called depreciation. For non-real estate assets, like a car for example, it truly does lose its value over time and will become a worthless asset. But the same is not true for real estate. You see, depreciation assumes that an asset will lose its value. But as we all know, real estate actually tends to appreciate in value over time. Yet, there's this write-off for depreciation expense. It's a huge tax incentive for real estate investors, and here is how it works. The formula is the cost of the property divided by its useful life. There are a few things to note here. First, the cost of the property should not include the land cost. Land is not considered depreciable property. Land can't be worn down or break apart, therefore is not included when determining depreciation expense. And two, the IRS already defines what the useful life of real estate property is. For residential property like a house, the useful life is 27.5 years, and for commercial property, it is 39 years. It is assumed that a home that someone lives in would probably experience more wear and tear than a commercial office building. This is why commercial real estate is deemed to have a longer useful life. Let's see an example of depreciation. Let's say you bought a residential property for $650,000. The land cost is included in this amount and is worth $150,000. This means the house itself is worth $500,000, or $650,000 minus $150,000. You would then take $500,000 of the cost of the property and divide it by the useful life of residential properties of 27.5 years to get an annual depreciation write-off of $18,182. Mind you, you didn't actually pay out in cash $18,182, but got the write-off for it. And you get that write-off every single year for 27.5 years or until you sell the property. This is called straight-line depreciation. Assuming no other expenses, if this property gives you $25,000 in rental income for the year, you would normally have to pay tax on that $25,000. And if your tax rate is 25%, it would mean $6,250 in taxes. But with depreciation, you now only have to pay tax on $6,818, which comes from $25,000 in rental income minus your depreciation expense of $18,000. Assuming the same tax rate of 25%, you would only have to pay $1,705 in taxes. Compared to $6,250, that's about $4,500 saved in taxes. So as you can see, real estate depreciation acts as a tax shield and reduces your taxable income. meaning you get to offset depreciation expense with the rental income you earn. This results in thousands of dollars in tax savings, as you just saw. And you know what you could do with those tax savings? That's right, invest in more real estate and do the same thing with multiple properties. Now, I know what you might be thinking. 27.5 years, and definitely 39 years, is a really long time to depreciate a piece of real estate. Well, you're right, it absolutely is. It would be even more beneficial to take more depreciation in the earlier years, especially if you only plan to keep the property for 5 to 7 years anyway. Well, I have another strategy you could take advantage of as a real estate investor if you want to accelerate or speed up your depreciation deduction. This strategy is for my hardcore real estate tycoons really looking to use the depreciation write-off to their full advantage. And it is called a cost segregation study. So up until this point, we've talked about depreciating the entire property over its useful life. With cost segregation, you can take bits and pieces of the property, like the roof or cabinets, and depreciate the cost of those items over a shorter period of time. This would allow you to take more depreciation write-offs in earlier years. In order to do this, you would need to hire a team of CPAs who are qualified to do a cost segregation study. You yourself cannot do a cost segregation study, only qualified professionals. And what they would do is identify the property-related costs that can be depreciated over 5, 7, or 15 years, opposed to the traditional 27.5 or 39 years. The cost to have one of these done will cost you, but will likely pay for itself by allowing you to accelerate depreciation on your property. Now, there is something you should be aware of as it relates to real estate depreciation, and that is depreciation recapture. So when you take depreciation expense as a deduction every year, you're reducing your basis in that property. In other words, you're reducing the implied cost of the property. If you paid $500,000 for the property and depreciated it for 1 year, your new basis or cost of the property is $481,818, or $500,000 minus $18,182 in depreciation. The true value of the property is obviously not going down, but for tax purposes, it technically is. So what does all of this mean? Excluding the land component here, for simplicity, if you sell the property after a year for, say, $700,000, you will have to pay tax on the gain, which is the difference of the sales price of $700,000 and your basis, which is now $481,818, or $218,182 in gains, opposed to paying tax on a gain of $200,000, which comes from $700,000 in your sales price minus the $500,000 purchase price. This is called depreciation recapture. This only occurs when you sell the property and have been taking depreciation on it. You can avoid depreciation recapture altogether through a 1031 exchange. A 1031 exchange is a swap of one investment property for another that allows capital gain taxes to be deferred and paid at a later date. So once you sell one property for a gain, you buy another property within a certain time period and defer paying taxes on the gain earned for the first property. If you want to learn more about 1031 exchanges, go ahead and comment 1031 in the comments below. That's all I have for today's video. I hope you enjoyed and learned something new about real estate and how you can take advantage of depreciation to lower your taxes as a real estate investor. Please subscribe to our channel for more videos on accounting and tax in your life, and I'll see you in the next video.